All right, good afternoon. Welcome, and thanks for coming or logging in. This afternoon we're going to be talking about some of the income options or withdrawal options available from the TSP. And we're really grateful to have an opportunity to talk about this because it's absolutely critical stuff, stuff that people really need to be aware of as they plan for that secure, comfortable, dignified sort of retirement. But unfortunately, we really don't give it as much attention as it probably deserves. Just so as you have questions this afternoon, feel free to send them to us at benefits@opm.gov, and Clyde will be watching for those questions, and we'll be happy to try to answer them, although I think many of the questions will be answered as we go through the presentation. So once again, the topic today is about really how to turn your TSP into a stream of income. I think in general we do a really good job when we talk about retirement readiness of encouraging people to save and encouraging people to make smart investment decisions, prudent decisions with their investments. I'm not convinced that we do such a good job of teaching them how to take their money out. And that's just as big a deal, just as worthy of the time and attention. The phase that we're in right now, the working phase, planners call that the accumulation phase. And of course the idea is to accumulate as much as we can. But that's not really the end. That's the means to an end. But no matter how big a pile of money you accumulate while you're working, it's only as good as our ability to turn it into a reliable, sustainable stream of retirement income. The second half of that process, that's what planners call the decumulation phase. And the TSP is really well designed to help us decumulate or help us make that money last. In fact, many providers in this retirement plan industry, the 401k plans and so forth, are just coming around to this realization that we need to do something more than just help people save money. The TSP has been designed that way from the get-go. And we're going to be talking about that for the rest of the afternoon. I like the analogy of like climbing a mountain. You know, while you're working, saving your money, that's the uphill climb. It takes a lot of work, a lot of dedication and training, but once again, getting to the peak of that mountain is only as good as your ability to get back down. So we hope that we'll be able to turn you on to some of the advantages of the TSP and some of the features that make it a great place to decumulate or to draw income from after retirement. The scope is going to be pretty limited today. Really, we're going to talk about one transaction. The transaction we call in the TSP the full withdrawal. And I'm going to try to address some, what I think are some pretty prevalent myths and misunderstandings, and also to try to clarify some of the language that we use at the TSP, some of our sort of proprietary terms that I think are pretty good, but in some cases are not intuitive to everybody, and maybe in some cases are even a little bit misleading. To start with the full withdrawal, we use that term, and it doesn't mean what it sounds like. Like, for example, and this is kind of a sloppy paraphrase, but you'll hear, for example, when you reach the age of 70 and a half, you have to take a full withdrawal. What does that sound like? It sounds like you got to take all your money out. You don't have to whisper, you can talk right out loud. Sounds like you got to take all your money out, and that's really not the case at all. Taking a full withdrawal really just means turning on one of those income options. So I could be one of those TSP millionaires you've been hearing about, 7-figure account, and request payments of $25 a month. Would that sound like a full withdrawal to any reasonable, literal-minded person? Probably not. But it is. And so that's one of the things. The actual options we're going to be talking about are the three that comprise the full withdrawal, those being the single payment, monthly payments, and the TSP life annuity. What makes these topical or what makes this current right now? Well, actually, these options have been available for a long time. They've been built into the plan for a very long time, ever since I've been around at least. The thing that's new is some guidance that the board put out last month in Bulletin 14-3, which sort of redefines the responsibilities of agency benefits officers preparing TSP participants for retirement. The old guidance asked you to hand them a hard copy withdrawal packet, withdrawal forms, the book, the tax notice, all that stuff. We have noticed, anecdotally, we know there's a huge misunderstanding. A lot of people think that for some reason when they leave, they have to take their money out. We have sort of determined that maybe handing them a withdrawal form when they retire has a little something to do with that. So we're hoping to kind of send a better message. 14-3 now asks you to simply make them aware of the website and the thrift lines so they can obtain current forms and pubs when they need them. This should also help the many people that retire and hold on to those forms until they're ready and then submit an obsolete form. So hopefully that'll make their transactions go smoother. They'll be able to use the wizards and so forth to speed up their process. The other thing that 14-3 requests, we're now asking agency benefits officers specifically to explain the income options or the withdrawal options in the TSP as people leave. Not in great detail. You don't need to do a deep dive into all the details and the regulations and the tax rules and all that stuff. But certainly we want them to know that the TSP offers them tools. These withdrawal options are tools they can use to come up with a customized income solution that's really going to address, hopefully, an awful lot of people's needs. We have seen, our data shows that quite a few people are withdrawing their TSP money and moving it to some other investment option, IRAs and so forth, when they retire. And we think a lot of that has to do with an education gap. We do think a lot of those folks would actually be financially better off if they understood the TSP, used the options the way they were designed, and kept their money in the plan. So hopefully we can kind of all partner together and make people aware of their choices and help them to make better informed decisions. I always think of a very prominent auto executive who was doing his own commercials years ago, and he'd come on screen and say, if you can find a better car than the one I'm building, you should buy it. And I have the same kind of confidence in the TSP. If people can find a better place for their money, well, they should move it. But I really think when you take a close look at the TSP and the options there and the various features, very few people would truly find a better place for their retirement money. So the options. As we look at these, we'll look at the terms that the TSP uses. We'll look at the forms and how these options are elected. But I want to kind of also describe them in functional terms. I want to get away from some of the proprietary language for a moment and talk about these options, how they're actually designed to work, what kind of outcomes you might expect if you choose these options, and in what circumstances people might find them valuable. And as we talk about it, I kind of lump them together into the flexible options and the guaranteed income options. Those are sort of the polar ends of the scale. And also, as you think about those two types of options or those two extremes, it's also about risk management. There are two very profound risks that we face when we're managing retirement income. One is investment risk. You know, we still have to be, in most cases, we're going to be making active investment decisions. We're going to be in those volatile markets and having to manage that risk. We're also balancing what planners would call longevity risk. I don't know how long I'm going to live. So as I start to divide my savings, this big lump, into a series of monthly payments or some kind of income, how long do I need to make it last? I just don't know. There was an old show, I can't remember the name of it, but one of those half-hour black and white sort of mystery shows where a guy wakes up and one day he goes out into the world and everybody he passes on the street has a number stamped on their forehead. And he realizes after a while, you get into the show, that this is how many days they have to live. And I can't remember how that episode ended, but if I was writing it, I would have made him a CFP. he would be the best financial planner ever. Because that's the one thing that we need that we don't have. If I knew how much money you had and when you were going to die, I could come up with the best financial plan ever for your retirement. But absent that information, it's a tough decision to make, and it requires most likely constant adjustments as you go through retirement. So that's the other two ways to view the extremes we're looking at. You can, if you're comfortable managing longevity risk and investment risk, then you can look at some of the more flexible solutions that allow you to maintain control. If you're not comfortable, it's possible to transfer those risks. And that's where we get the guaranteed solutions. They're less flexible, but they allow you to transfer some of the risks and have basically have the actuaries make those decisions for you. Another choice that we have is the choice to do nothing at all. Most of your employees, when they separate, unless they're 70 and a half or older, can just wait. So if they have income from other sources, if they just don't really know what retirement's going to be like and want a little bit of time to settle into the new lifestyle, there is absolutely no hurry to rush in and make a decision about the TSP options. The only thing that limits our ability to just leave the money in, let it grow, and continue to defer the taxes is a rule about what's called required minimum distributions. And we'll talk about those intermittently as we go through the afternoon. But basically, when you reach age 70 and a half, there is a requirement that you start receiving some income from the TSP, because it's the only way the IRS can do their job. They have to collect revenue, and they can't do that until we start receiving income from the plan. So the first option I want to look at once you decide to start the income flow is the most flexible of the options. We call it monthly payments. What this really is a series of scheduled systematic withdrawals from your TSP account. You tell us one time, I want to start monthly payments, and when we process that, we cash out just enough shares in your TSP account to make the payment you specify. I want $500 a month or $1,500 or whatever. There's no upper end limit. The minimum limit is $25, and the rest of the money effectively just stays in the TSP. Even though you have set aside a certain percentage of your balance to make these payments, the amount that stays in the TSP is working for you just like the balance you have while you're an active employee. It's still invested, it's still generating earnings, and it's still tax deferred. But on the anniversary of that first month's payment, the month later, we'll cash out shares again and make the next month's payment, and so on and so forth. All year long, every year, as long as you live or still have money in the account. This is a self-directed option. This is the do-it-yourself option that says, I want to make active decisions about how fast I decumulate or pull the money out of my account. I want to make active decisions about where it's invested. I'm comfortable with all that risk, and I want to control this. These monthly payments at a fixed dollar amount are, well, it's a great idea because we may not know what our cash flow requirements are going to be for the rest of our life, but we can pretty well assume they're going to change over time. So this gives me the flexibility because I can make annual changes in the amount of my payment. This gives me the flexibility to make those changes every year. It might be based on my lifestyle, the cost of the cost of living. It may be based on investment performance. If we have another year like 2008 and I get beat up a little bit, I may choose to slow down my payments and kind of recover. If we have a real banging year in the stock market and I find myself with more money than I thought I was going to have, I could always increase the payments. And it could even be used sort of tactically. People may have tactical reasons why they want to change their payments. For example, I might be retiring with a mortgage and I have a couple years where I'm going to need more money every month to pay the mortgage. So I could expect to take larger payments up front, and then when my debt's cleared away, make the payments a little bit smaller to make the money last. Perhaps I could do the same thing to delay Social Security claiming. Take more money now to bridge the gap, postpone Social Security, and then reduce my payments when I make my claiming decision. And it could work the other way. Maybe I have a working spouse that's going to continue to work for a few years after I retire. I don't need a lot of money. I could start, modest monthly payments and let the rest of my money grow, stay tax deferred. And when my spouse retires, increase the payments to make up for her lost income. We aren't going to do the strategy. We aren't going to tell people what to do. But I think it's important to let them know that there's a tool that they can use to do this kind of thing. There is another way to receive monthly payments, one that allows you to transfer the longevity risk. If you're not sure about how long you're going to live and don't want to just guess, we do have a monthly payments based on life expectancy. This form of payment is computed by the TSP. So it's still flexible in that the money's still in your account. We're only taking out and cashing out enough shares to make the payments every month. You're still going to be making active investment decisions as you receive these payments. But the TSP is going to compute the amount of your payments based on life expectancy. And the life expectancies are pretty long. We use the same life expectancies as are associated with required minimum distributions, which are designed not to deplete the account real fast, just to start a flow of income that hopefully is going to be sustainable over a long period of time. So for those that want a little bit of help while retaining control over their money, TSP monthly payments computed by the board or by the TSP could be a good solution. There's a tool on the website as you counsel folks or try to illustrate the differences between. One of our calculators is called the Retirement Income Calculator. It's a pretty handy tool, actually. And this can be used to illustrate some of the different forms of payments. We're not live on the calculator. This is just a screenshot. But you can see I put in a balance and I put in a payment amount of $1,500. And the calculator shows me on that top line how long my payments could be expected to last. Now, that's based on my assumptions, which is not, a nice word for guesses. It's only as good as the information I put in. And honestly, this is not a one-time exercise. This is an illustration. It's not a crystal ball. It doesn't have any predictive value. And again, if I choose monthly payments at a fixed dollar amount, I'm telling the TSP that I want to be an active manager of my retirement income. So this isn't an exercise that you do one time. It's probably something you would do maybe annually to see if you need to adjust your payments or not. It assumes that all my assumptions that I put in are valid and correct, which is never going to happen. It also assumes, as you look at that line, that I never make any changes, and that probably shouldn't happen. As an active manager, an active decision maker, I should probably be checking and making those adjustments. The lower line on the calculator illustrates what would happen under the same circumstances if I had told the TSP to compute my payments. And you can see, generally speaking, if the TSP is computing my payments, I'm going to get a little bit of a cost of living increase every year because they're based on life expectancy. And every year as my life expectancy gets a little bit shorter, that causes the TSP to take a slightly larger percentage of my account balance for my payments. You'll also notice there's an adjustment at age 70. That's because there are two different tables of life expectancy in the Treasury regulations. Starting at age 70, we use the minimum required. Prior to that, we have to use a different table. So there's kind of an awkward adjustment at age 70, and if you have employees that are thinking about requesting this option, it's especially important, I think, that they run the calculator and take a look at this illustration, because that looks like, about a 30% pay cut when I go from age 69 to age 70. And it is avoidable. They could switch the form of their payments if they know that's coming. But just kind of a helpful hint. That's one of the, I think, sort of the quirks of this form of payment. Having elected monthly payments, you retain a lot of flexibility. Participants receiving monthly payments, if you're receiving a dollar amount, you can always at the end of the calendar year, request a different dollar amount. It is a change that's annual, once a year, and it has to be done during that window between October and December. But I can change the amount of my payments every year from the time they start. I can also, if I have elected payments by life expectancy, I can switch from life expectancy payments to payments by a dollar amount. So if I try that out and I don't like it, or I'm getting ready to turn 70 and I don't like what's going to happen, I can always switch to a fixed dollar amount. Having switched, I cannot return to have the TSP compute my payments. So that's a one-time option. And the other flexibility that I have, if in fact I ever do find a better place for my money or have a need to get all my money out of the TSP, I can always request a full final withdrawal. So you're not locked in having elected monthly payments. I also, because here's one of the most frequent questions, once I retire, will I still get interest? Well, a lot of the earnings you get in TSP aren't technically interest, but I know what you mean. And the answer is yes. If you have money in the TSP investment funds, you're going to get market returns. Now, depending on the fund and what's going on in the market, they may not always be positive. But you will get market returns just like active employees. And you will still be able to do 2 interfund transfers every calendar month. So you still have as much freedom after separation as you do right now to move your money and take advantage of all 10 TSP investment funds. I also wanted to point out one of the TSP funds is specifically designed to be a companion to monthly payments. You don't have to use it. It's just a tool that's available. But the L Income Fund is part of our life cycle fund family. It is a static allocation. The others are dynamic, where the allocation changes over time. The L Income Fund is a static allocation. It's 80% fixed income and 20% the stock funds, CS&I. So it's not guaranteed against losses because you do have a little bit of skin in the game as far as the stock index funds go. But there's so much G fund. The orange slice there is the G fund, 74%, and the rest of the fixed income portion is the bond fund, the F fund. So it's very, very conservative. For example, in 2008, when the markets lost so much, we had that dramatic losses in other funds, the L Income Fund lost about 5%. And when the markets recovered, that little slice of CS&I funds helped it to perform quite a bit better than the G fund alone. So again, this is just a tool. It's not a requirement, but this is designed to be a really helpful companion to those monthly payments. Another opportunity we have after separation, even if you've turned on the monthly payments and you're receiving income from the TSP, you can continue to do rollovers and transfers into the TSP. So some of your folks may be retiring at a young age. They're going to go on to a second career, and perhaps they're going to fund a 401k plan in their second career. Well, when that's done, if they want to move that into the TS, even if they haven't talked to us in 15 years, they can come back and transfer the money from their 401k plan into the TSP. Or if they have traditional IRAs, either going into retirement or something they can fund after retirement, we can continue to take transfers from traditional IRAs. So if they have a traditional balance, employer plans like 403Bs, 457 plans, 401k, and traditional IRAs are all eligible for transfer into the TSP. If they have a Roth employer plan, like a Roth 401k, that money can be transferred into a Roth TSP balance. The one color of money we can't take is Roth IRA money. That would be, we couldn't accept that. But just about any of these other employment or retirement type accounts can be used to add funding to your TSP balance. And it's a pretty simple process. Form TSP 60 has really just a few lines that the participant has to fill out. There is a section that has to be certified by the custodian of the IRA or the plan administrator. And it's not instantaneous. It may take a little while for us to get the transfer check and get it credited to the account. But if they do a direct transfer, it's a pretty clean process. The other income option from the TSP, this is the one that provides guaranteed income, is the TSP Life Annuity. And again, the terminology can be confusing a little bit because the pension, the defined benefit component that gets paid by OPM, is also referred to as the FERS annuity or the SERS annuity. The TSP Life Annuity is a completely different source of income. And also, the TSP Life Annuity produces a stream of monthly payments, but it's a completely different option from the TSP monthly payment option. This option uses the insurance principle. It's kind of a pooled investment, and then all the people receiving the TSP Life Annuity are guaranteed income for the rest of their lives. So it's a very effective way to manage longevity risk. It's a great way to create another source of guaranteed income you know will last for life. And it can make a great companion to those monthly payments. The TSP annuity is a much less flexible once it's elected. But going into it, there are actually 18 different variations on the contract. So it can be set up to really cover a variety of different needs. The basic forms of the annuity are single life and joint life. So you can cover yourself only, or yourself and a spouse, or yourself and a significant other. The payments can be received in a level stream, the same dollars and cents every month, or you can elect increasing payments. So if you expect a long retirement and want to build in some inflation protection, increasing payments are an option. It's also possible to build in a death benefit, and this is one of probably the biggest psychological hurdle that we face when you're buying an annuity. People just hate to take that hard-earned lump sum of cash and turn it over to a third party in exchange for a guarantee or a promise of future income. And I don't know where all these people are that get hit by buses 3 days after they retire, but that seems to be the fear. And I can understand, you know, if you die prematurely, a lot of people are very uncomfortable knowing that they paid all this money for a benefit that they're not going to fully receive. So there are two forms of death benefits available. There's a thing called 10 years certain that can be built into the contract. That guarantees that the payments from the annuity will continue for a minimum of 10 years. So I can see, like if I were a single dad with a 12-year-old, that would give me a whole lot of comfort, knowing that if I did pass away early, you know, not a joint annuitant, but my beneficiary would receive payments for the remainder of that 10 years. Now, if I outlive the 10 years, it basically has no effect on me. I'm still getting income for the rest of my life. This only kicks in if I pass away early. There's also a benefit called the cash refund feature. So if I choose that, then when I pass away, if I have not received all my principal back, my investment in the contract, then MetLife will pay, that's our annuity vendor, MetLife, then they will pay the difference to my beneficiary. The other benefit is for joint annuitants. If you elect a joint annuity, you have to choose between a 50% survivor benefit and a 100% survivor benefit. 100%, that's pretty intuitive, right? That just means the benefit doesn't change at the death of the first spouse. The 50% survivor benefit reduces the benefit by half at the death of the first spouse. And literally, it's at the death of the first spouse. It doesn't differentiate between the employee and the dependent spouse or whatever term you want to use. So very important to understand, when one spouse dies, the benefit's going to be reduced. But the potential advantage of the 50% survivor benefit is, well, just like with all these features, they aren't free, right? The annuity vendor has to keep enough cash in reserve to pay for all these extra bells and whistles. So as you choose these features that have more protection down the road, you have to give up some of your near-term benefit. You're going to get smaller payments because you elect these additional features. So the 100% survivor benefit could be a great way to cover if you have a spouse, for example, that maybe doesn't have a lot of assets of his or her own. But if they don't need that necessarily, the 50% survivor benefit means you're going to get larger payments up front. You're going to get your investment back faster. You're going to have more money to enjoy while you're both alive to enjoy it. And the same thing with the death benefits. They can give you some peace of mind knowing that if you pass away before you use all your money, somebody you care about, your beneficiary, is going to enjoy the benefit, but you're not getting it. You've got to die to kick that in. So it's, you know, is it worth the cost? You may look at the cost and decide if the peace of mind is worth giving up a few dollars every month of your own income. You may choose to find other ways to take care of your heirs and just pick a very simple annuity that's going to maximize your income for the rest of your life. And that's your choice. This table is on the website, so if you have participants that are interested in the annuity, want to compare the features, they're all right there. And the retirement income calculator that we mentioned earlier also will model the annuity payments. And you can see the screen grab by here has 4 different combinations of annuity features, and it allows me to compare side by side what's the cost of a 50% survivor benefit versus a 100% survivor benefit. What's the cost of increasing payments versus level payments. So I would suggest if you're trying to compare these features, set up the calculator so that you've got a baseline annuity, single life annuity, with no extra features or something like that, and then turn on other features so you can see how much they're really going to reduce your payments. There's also a chart available on the website that can help people compare not annuity features, but compare annuities to monthly payments. And we've already talked about the difference. Monthly payments are more flexible. They allow you to retain more control over your account, but they force you to retain more risk. The annuity is not very flexible. However, it's guaranteed. You don't have to worry about market volatility. You don't have to make active decisions. There are all kinds of reasons why people might shy away from the annuity because of the lack of control. But there are plenty of reasons why we find that people really value the annuity. Number one, it's never going to run out. That's comforting. Number two, some people are just a little nervous about having that lump sum to manage. They're concerned about being scammed for their savings or taken advantage of by a relative that's kind of maybe a spendthrift or always needs something if they know you got the cash. Some people just have cognitive impairments in the family. They know that a lot of my family members had Alzheimer's or something, and I don't want to be making financial decisions when I'm 80. So it's a tool that's available. Not everybody needs one, but it's great to know it's there if you need it. The last option on the form is the single payment withdrawal. Clearly, if you found a better place for your money, this is how you get it out. But the single payment can also be combined with the other options. And we've illustrated here what we're going to talk about next is a mixed withdrawal, where the single payment could be maybe a fairly modest percentage of your account and blended with other options. Another tool that's on the website available for you is a comparison between the different withdrawal strategies. This covers the options that we just finished talking about. Each one of these is collapsed, but if you open them up, there's a whole explanation of what they might do, who might be interested in them, and how you could expect them to work for you. You need money right away for an important purchase. Which option, I suppose, we're talking about there? Single payment. Boy, you guys are quiet. You want money. You want to avoid paying taxes for as long as possible. Wild guess? Deferred. Do nothing. You want to receive a payment every month. Key words in there. Monthly payment. And you want guaranteed income to last your lifetime. There's the annuity. So again, just another place to go to kind of get an explanation, a functional explanation of each of those withdrawal options. And the thing I like best, The mixed withdrawal is a way to put all these together. Again, you don't have to pick the most flexible, riskiest solution. You don't have to pick the guaranteed least flexible. You can combine these, blend them into something that's going to land in that sweet spot, somewhere in the middle. And it's also important to remember that the TSP is not your whole income. This is a supplement. So your FERS employees and your CSRS offsets are going to have the pension plus Social Security. Straight up CSRS are going to have the pension alone, but it's going to be a much more substantial pension. And they may have other outside investments or other, spouse's pension or spouse's investments or other sources of income. So the TSP's got to fit into a unique place and kind of fill the gaps. And it'll be a little bit different for everybody. Everybody's going to have different needs to account for. This is one more tool on the website. We have retirement income choices with kind of little scenarios illustrated. A couple that chose the joint life annuity, a gentleman that chose the monthly payments, and Susan down there that chose the TSP mixed withdrawal. And her scenario is something like she's going to buy a cottage, so needs a single payment for the down payment and an annuity for fixed expenses, and the rest is going to be monthly payments. But very helpful. They kind of, again, they make it sort of real. And it's very, very easy to elect. The decision may be hard, but the process of setting it up is pretty easy. All we ask is that you designate a percentage of your account for each one of the options. So you could do 100% to any one option or a blended solution. Right now, basically the only restrictions on requesting a full withdrawal, number one, all these options are immediate and simultaneous. So you couldn't start monthly payments and come back for the annuity later or something like that. The other thing is, under the current rules, the minimum amount that you can designate toward the annuity is $3,500. So, and believe me, when you're trying to stretch it into, out for the rest of your life, $3,500 is a very, very small annuity purchase. Once the decision's been made, just designate a percentage for each option. They have to add up to 100. And submit the form. And boom, you're pretty much done. There are some other considerations. As we go, of course, the TSP is a tax-advantaged benefit. And there are many, many aspects of the tax rules that employees should consider before they lock in their decision. Of course, Congress was very, very careful when they created plans like the TSP to make sure they weren't going to be used as like a multi-generational tax shelter. So there are rules that say you got to start taking your money out eventually. And because it's an incentive to save for retirement, really, there are rules that say you can't take it out before retirement without a penalty. There are all kinds of stuff. We'll talk about them one at a time. The slide up there now is an abbreviated version of a publication you really need to get. TSP 536, it's titled Important Tax Information About Payments from Your TSP Account, is kind of our basic tax notice. A lot of very, very important information, and it has a version of the table on the slide that's much, much bigger and more helpful. But basically, the two things that are described here are the withholdings and the portability, or the ability to transfer money during these transactions. Another very common question is, what's my tax rate when I retire? Or what's the tax rate on TSP withdrawals? We can't tell you that. We can tell you that if you have a traditional TSP balance, everything in the TSP, when you withdraw it, is going to be taxed as ordinary income. So it'll be lumped in with all your other income, all your other taxable income, and that's what will determine your tax rate. We can tell you, though, the withholding rate, because we do have to withhold money from most payments and send it off to the IRS. And there are basically two kinds of payments that determine that withholding rate. Lump sum payments, like the single payment that you might request as part of your full withdrawal. Or if you've been getting monthly payments and you decide to stop those payments and ask for a full final withdrawal. Those lump sum payments require us to send 20% to the IRS. That's the withholding. It's not a tax rate. That's how much is withheld from your payment and send. It's kind of a down payment on your taxes. Those types of payments, the lump sum payments, are characterized as eligible rollover distributions. And that means you can also roll over or transfer them to another tax-favored plan. So if you do that, then there is no withholding. And we'll talk a little bit more about those transfers as we go through. The other form of payments, your monthly payments, with one exception, your monthly payments are treated under a different rule. They're characterized as periodic payments. And the withholding on that is, well, it defaults to married with 3 exemptions. So if you don't tell us any different, we treat you as though you're married with 3 exemptions. We go to the withholding tables and base our withholding on that. But that's just an assumption. It's just a starting place. So if you're receiving periodic payments, these monthly payments, then you actually have the freedom to raise the withholding or lower it or waive it altogether. Now again, that doesn't waive the taxes. And there are penalties for not having enough withholdings taken out. So it's something you'd probably want to talk about with your tax preparer or your accountant or your financial planner. But you do have a lot more flexibility to manage your cash flow because of that. The thing you cannot do with those periodic payments is transfer them to an IRA or another employer plan. So there's no way to avoid the withholding by doing a transfer, but you can adjust it. There is sort of a middle ground here. There's kind of a in-between. If you're receiving monthly payments and you specify an amount that's going to deplete the account in less than 10 years, then those monthly payments are treated the same way we treat lump sum withdrawals. Each payment will be subject to a 20% withholding, and if you choose to have those transferred to an IRA or another employer plan, you can avoid the withholding and postpone the tax. So short-term monthly payments are treated differently from the typical long-term periodic payments. You can also, in some cases, kind of change the color of your money by doing a transfer or change the tax character. Now, if you have money in your traditional balance and you have it transferred to a traditional IRA or a traditional employer plan, nothing changes. Okay, it's the same color of money, it's the same tax treatment. So that transfer does not trigger any withholdings, there's no penalties, and there's no tax. Same thing when you withdraw money, if you have a Roth balance and you have that Roth money transferred to a Roth employer plan or a Roth IRA, it doesn't change the character of the money. So there's no withholding, there's no tax, there's no penalty. You can, however, have money transferred from your traditional balance to a Roth IRA. That changes things. What do you suppose happens when you take money that has never been taxed and transfer it to a place where it may never be taxed? You're going to pay taxes. So there's still no withholding and there's no penalty. But for employees who choose to withdraw their money and transfer traditional money to a Roth vehicle, there is income tax. We have to report that on a 1099. It'll be taxable during the year of the transfer. Also, and we see a fair number of people who do this, and there may be perfectly good reasons why they want to take their TSP money and transfer to an IRA, but we think an awful lot of people are doing this without being fully informed. Before, and I know you're not advising people, but before an employee transfers money from the TSP to an IRA, we hope they're really making an informed decision. Of course, we talk a lot about our expenses. The TSP is an employee benefit. It's not a for-profit plan. So we have low expenses, obviously, partly because of our scale, partly because we don't have any shareholders to pay. We aren't charging any loads or sales charges. We aren't paying commissions to anybody out there. You know that, right? The benefits officers. You don't get any commissions for anything that the TSP happens. We also have, we're held to a kind of a higher standard of management. The TSP, because it's an employer plan, is managed by fiduciaries, people that have to act in the best interests of the participants. Well, that's a little bit higher bar than a for-profit firm that's marketing IRAs. There are also other things. There are possibility of an earlier exemption to the early withdrawal penalty. You might be able to use your money at a younger age because the TSP is an employer plan rather than an IRA. There are protections against creditors built into an employer plan that aren't necessarily built into an IRA. So there are all kinds of things that might tip the scale in favor of the TSP. And again, if people truly value what they can get from another plan or another account, that's great. We want to support them and make sure they can do whatever is in their best interest. But we do think a lot of people are not, there's an education gap again. They aren't quite as aware of the benefits of staying in the TSP and would probably, if they knew, they'd probably leave more of their money there. The expenses alone are compelling. The cost of being in the TSP last year was 0.029%, 29 thousandths of 1%. The cost of being in a typical retirement plan like a 401k, according to the Investment Company Institute, was about 0.83%. That sounds like a pretty small number. Less than 1%, so what? But it's about, what, 25 times more than the TSP. And over time, you know how compounding works when you're saving money and trying to grow your account. Your expenses compound over time also. And over a 30-year retirement, that extra drag on your expenses could reduce the money available for your retirement by possibly tens of thousands of dollars. So just enjoying the lower costs alone could put a lot more money in a retiree's pocket. Another tax effect we need to be very, very well informed about is the early withdrawal penalty. Again, Congress was very careful about making sure the tax advantages accrued to retirees, people that were going to use this the way it was intended. The general rule is 59.5. If you leave your money alone until 59.5, the penalty goes away. Because we're an employer plan, there's an additional exemption, and this is for folks who separate or retire during or after the year they turn 55. Now, this is very closely tied to your employment and your employer plan. So we're talking specifically about folks who retire from federal service during the year they turn 55 or later, and withdrawals from the TSP. So this does not help eliminate the penalty for your IRA withdrawals or from some other employer plan from a previous job. It's the TSP and your federal employment. But that can sure be helpful, especially if you have those folks like the air traffic controllers or firefighters or law enforcement officers that need to retire early because of the rules. They can go at 55 or later and have an exemption to the early withdrawal penalty. There are also two specific options that waive the penalty. One is the TSP Life Annuity. So folks who are retiring early and are looking for a way to draw income without being penalized, well, if the annuity works for you, that's one easy way to get penalty-free payments at any age. It's also possible to avoid the penalty by having the TSP compute your payments, the second option we talked about. Sign up for monthly payments, tell the TSP to compute them based on life expectancy, and they will be penalty-free. Now, that option comes with a little bit of a caveat, because that is only penalty-free as long as you don't change the form of your payments. If you were to sign, let's say at age 52, I separate from the government, start payments based on my life expectancy, I'm good to go. If 6 years later, at age 58, I decided that doesn't work for me anymore, and tell the TSP to just send me $700 a month. Well, by changing the form of my payment, I lost my exemption to the penalty. And the IRS is going to have to levy that 10% penalty, not only on my payments going forward until I turn 59.5, but they also have to recapture the penalty going back. So I could end up paying a 10% penalty on 6 years' worth of income, which would be a very, very high-priced mistake. So, and I've heard planners address groups of federal employees and recommend that they consider that option. It's okay, but it's one you would really want to be committed to and know that you could stay committed until you were completely free of the penalty. Then there's those pesky RMDs, back to the required minimum distributions. We've mentioned them a couple times. One of the nice things about the TSP is that we will help you satisfy these required minimum distributions. And that should be very comforting. When you reach age 70 and a half, if you are separated, you'll have to start taking income from the TSP. The penalty for failing to take a required minimum distribution, anybody know what it is? It's high. It's 50% of the amount you should have taken. So if your RMD for the year was $12,000 and you failed to take it, the penalty alone is $6,000. Now the TSP, again, the TSP will help you make sure you comply with that, make sure you satisfy the requirement. So we'll send you notices. We'll let you know it's coming. We'll compute it for you, and we'll even send you the first one. If you do nothing, we'll send you the first one, like it or not. But after that, you absolutely have to comply by selecting a withdrawal option. And any withdrawal option you select from the TSP will satisfy the requirement. It's simple. So if you turn on monthly payments, let's say you're that TSP millionaire that asks for $25 a month. Well, that's not going to satisfy your RMD for the year. But the TSP is watching. We will be monitoring your payments throughout the year. We will have calculated your required minimum distribution for the year. And at the end of December, if you haven't received enough to satisfy the required minimum, we'll just cut you a supplemental check. We'll send you a 13th check for the year to make sure that you're compliant. A lot of folks like that. They call it their Christmas bonus. If you're receiving monthly payments based on life expectancy, well, the life expectancies that we use to compute your payments are the same ones that the IRS uses to compute your required distributions. So by definition, if you're receiving payments based on life expectancy, they will satisfy the required minimum. And of course, if you take a single payment, that's easy. The one thing is, if your single payment is being transferred, any portion of the single payment that's designated as a required minimum distribution will be paid to you directly. You can't avoid the tax on it by transferring it, but you won't be penalized anyway. And this might give people a couple more reasons to consider the TSP over, say, having their money spread out among a few different IRAs. Number one, if you choose to work past age 70 and a half in an employer plan, you don't have to start your required distributions. In an IRA, well, you do. Also, if you have your money spread out among multiple IRAs, your RMDs have to be calculated based on the aggregate amount. So if the TSP is much easier because it's all in one place, we do the calculation, we help kind of make sure that you're compliant. If you have multiple IRAs, no one of your custodians can do that for you. So compliance and reporting can be a lot more complicated. And there's even, I like to keep it simple and just say the year you turn 70 and a half, you have to take your first distribution. That's a little bit oversimplified. There's even sort of a grace period. So your required beginning date, the first RMD, actually doesn't have to be paid to you until into the first quarter of the next year, by April 1st of the year following the year you turn 70 and a half. But beyond that, every RMD has to be received by the end of December for the year in which it's due. A lot of people want to know how much their RMD is going to be, as though it's a fixed amount. The RMD is actually calculated. It's your account balance divided by your life expectancy. So I just threw these in here. Actually, you can find these, a nice legible chart. This is from a TSP tax publication, important tax information about your TSP withdrawal and required minimum distributions. You can also find these tables in IRS publication 590 at Appendix C. So this would allow a participant to get a pretty good estimate of their required distributions. We use the account balance as of the end of the prior year, so it's the account balance that shows up on your annual statement as of December 31st. We divide that number in the column that says distribution period. That's the number of years you're expected to live, statistically, or at least according to the IRS. So at age 70, we would divide your account balance by 27.4. That gives you your RMD for the year. If you're receiving monthly payments, we divide that by 12 and pay it out in equal increments. Another tool I wanted to make you aware of is the Withdrawal Wizard. Most of the shots I've had here are of the withdrawal form, the paper form. Roth was great. Remember a couple years ago we introduced Roth. It's been a real boon. But I'll tell you what, some of the options associated with Roth, the additional transfer options and stuff, have caused the forms to become longer. The TSP 70 is now 16 pages long. It's not as bad as it sounds. There's a lot of white space. But it's still a bit of an exercise. We're really proud of the Withdrawal Wizard, though. Rather than printing out the paper form and filling it out longhand, strongly encouraging people to go to their account and follow the links to withdrawals and just answer the questions in the Withdrawal Wizard. That's designed to prompt you through all the options on the form. And of course, it's in your account. So it can see which, like if you don't have a Roth balance, it's not going to ask you any questions about Roth transfers. It bypasses all the irrelevant stuff. And once you've filled out all the questions, it'll populate the form and print it out ready for the notarized signatures. Makes it a lot easier. And it's a very, it's going to be legible, it's most likely to be in good order, and it's going to process fast and save a lot of headaches. So again, we would love to see you encourage people to use the Withdrawal Wizard, and that's probably one more reason, that's another good reason why we are now discouraging the hard copy withdrawal packets, because the forms are really not necessary anymore. Other resources, there are two primary print resources. There's a lot of booklets and stuff out there. But the two primary print resources, one is the book called Withdrawing Your TSP Account After Leaving Federal Service. That describes all the plan rules that we've talked about this afternoon. The purple publication up there is the tax notice that we mentioned earlier, important tax information about payments from your TSP account. You can call our thrift line and request copies, but you can also just print them directly from the website. So if you don't care about the glossy covers, you can print out the PDF. And all the web-based resources that we've looked at today are right there at tsp.gov. And in fact, there's more than what we were able to talk about today. Once your employees leave, of course, they aren't going to have you to help them anymore, so they're going to have to get used to contacting the TSP on their own. Certainly would encourage them to use the thrift line. We have service reps on the phone from 7 a.m. to 9 p.m. every business day. The web is always open. And now we have the ability to do secure messaging through the website. So this little, up in the upper right-hand corner of the screen, you see what the tabs look like. If you go into your account on the web, you can send secure messages. They'll be answered timely. And of course, the person responding can see your account. So they can answer very specific questions about your account or your situation. Of course, the website now we have, it's mobile enabled, so you can access the website from your smartphone. And you can also keep up with us on YouTube and Twitter. We have a lot of little animated videos on YouTube these days that can walk your employees through how to change your address after you retire and things like that. So, and just a couple of last suggestions here. Number one, we'll process your forms as quick as we can once you're separated. But we get a lot of people who would like to set this all up in advance and send the form. We can't accommodate that. And be aware that the separation code comes to us when your active pay account is closed out. So your official retirement date doesn't mean that the TSP knows you're separated. that if all is going well, that probably happens about a month later. So you can encourage people to call us and ask if we see them as separated yet. The delay's minimal, but we do need people to wait until we are actually notified of their separation before we can process their withdrawal requests. Consider using the online wizard to complete those forms. It's just a lot easier. Talk to your spouse, because the TSP is a family asset. If you're married at the time you're requesting withdrawal, we need that notarized spouse's signature. And so, start those conversations now, because it's something you're going to have to agree on. And finally, just remember to stay in touch. Once your employees retire, again, they aren't going to have you to help them anymore. They're going to have to reach out to us. And so when they move to that condo in North Florida or wherever, make sure they remember to send us their address. That's where you're going? So, I think I'm done. Subject to your questions. Thank you very much. Clyde, have you been getting questions?
We have over 90 questions, but we're not going to attempt to cover 90 questions, I don't think.
Probably not.
First is TSP. TSP has a 70-and-a-half-year-old rule for withdrawal. Is that for retirees, or does that rule also apply to active employees who meet that age?
If you're 70 and a half and still working for the federal government, you do not have to start your required distributions until the year of your separation. And again, that's just TSP. That doesn't postpone the RMDs from your IRA accounts or other employer accounts. But yeah, TSP, if you're still working, they don't start until you retire.
Next up, for those who have contributed both to Roth TSP and traditional TSP, how do withdrawals work? Can one elect to draw, which one to draw down first?
No, not under the current rules. If you have, and let me back up. The TSP, when we distribute money from the plan to you, we always do what's called a pro rata distribution. Money's taken proportionally from all the sources in your account. So now that's always been the case, and it works for your funds. So for example, if 30% of your money is in the C fund and 70%, I had to do math like in front of people, 30% is in the C fund and 70% is in the F fund, well, you take $1,000 and 300 is going to come from C and 700 from F. That's pro rata distribution. That rule, since we implemented Roth, applies to Roth and traditional as well. So if 90% of your money is traditional and 10% is Roth, then 90% of each distribution is going to come from the traditional balance and 10 from the Roth. Now that might change over time. The board has committed to re-looking that rule, and it's possible that it'll change over time, but that's how it is right now. You could, though, as we mentioned, you have separate transfer options for that. So if you're getting a distribution that has both Roth and traditional money in it, you can tell us to transfer both or either one. You could transfer the traditional money to a traditional IRA, the Roth money to a Roth IRA, and then you'd be able to control them separately. Just can't do it from the plan right now.
Now, this person will be retiring in 3 years, and they've been advised to put the money they now have in, that's in traditional and switch it to a Roth. Should they switch to a TSP Roth?
That's a very personal decision. I don't know that I could, a financial planner that really knows you and your situation could probably make a good recommendation. Roth and traditional are really just different. I guess if I had to throw out a rule of thumb, higher income employees who think maybe that they'll have lower income in retirement might do well to stay in traditional. Lower income employees who think their income might be higher in retirement, that makes Roth pretty appealing. But that's not a hard and fast rule. There may be all kinds of other things in your tax situation that would prompt a decision. And you don't have to pick one or the other. I mean, you can maybe find a sweet spot with some traditional and some Roth. Not a very good answer, but that's, I think, as the best advice I could give.
If this person says, if I don't take money before then, what percentage of my money do I need to withdraw at 70.5?
Well, 70, what did we say, 27.4 years?
You were there.
Yeah. At age 70, your life expectancy for tax purposes is 27.4 years. So at that point, we would divide your account balance by 27.4, and the result of that calculation would be your RMD for the year.
Several employees over the past few years have had their financial planners advise them to transfer their TSP account to IRAs due to more flexible withdrawal options. Can you speak to this? Is it true?
It is true. You'll have more flexibility with your withdrawal options. You'll have probably more investment choices if you switch to an IRA. So that's where you want to weigh that. Are those additional choices worth enough to justify the additional costs of an IRA and giving up some of the other benefits? Again, if you're 59 and a half, there may be no value in the age 55 exemption to the penalty. But if you're younger, that could be worth a lot of money to you. Same thing with the legal protections of being in an employer account. They're two different places. The big advantage of the TSP is the low costs. You'll keep a lot more of your own money if you choose the TSP. But if you need, like ad hoc withdrawals here and there, kind of access to your money, the TSP isn't set up to do that. So you might have to leave, and you don't have to take all your money out of the TSP either. An individual could leave most of their money in the TSP and transfer out a modest amount into an IRA and use that as their emergency fund or their kind of discretionary fund.
I plan to quit working at age 62 and not to take TSP withdrawals until age 70. May I continue to add money to TSP after I quit working?
Not in the form of regular contributions. After you retire, you can't make those regular contributions to the TSP. You could, however, if you're eligible to fund a traditional IRA, maybe from a part-time job or previous contributions while you're working, you could transfer IRA money into the TSP. Or if you have a second career from age 62 to 70, you might have a 401k that could be transferred into the plan. But you can't write us a check.
Can you choose the full withdrawal option at any time after retirement?
Basically, yes. From the time you separate until the time you turn 70 and a half, you can wait as long as you want, and you can submit your request for a withdrawal any time during that period. You do have to request your full withdrawal, though, by the year following the year you turn 70 and one half.
Last one here. What percentage of the population chose each type of withdrawal options? For example, monthly withdrawal, annuity, different types.
Oh, I don't know percentages. I think it's really driven a lot more by your needs. And again, you don't have to just pick one. If it were me trying to make the decision, and it will be eventually, I would start by looking at my non-discretionary expenses. And what's it going to cost me to live in retirement? My housing and utilities, food, medical, transportation, all those non-discretionary expenses. And compare that to my FERS or CERS pension, my Social Security if I've got it, and any other sources of real solid income. If my pension and Social Security are going to cover that discretionary or the non-discretionary expenses, then I may be happy to either postpone my withdrawal or just take monthly payments at a modest amount. If not, then I might probably get on the TSP retirement income calculator and price myself an annuity and use the annuity as kind of a third pension or a source of guaranteed income that would make sure that I've got those bases covered. Then the rest of my money I could use to receive monthly payments. most of that money stays in my account. It's going to keep growing. It's going to give me some ability to participate in the market. And I would also probably want to look at my ability to, how resilient am I going to be in the face of emergencies? You should have an emergency fund, right? Everybody tells you that. Used to be 3 to 6. Now they're talking like 6 to 8 months of income. And I'll tell you what, when we retire on a fixed income, those financial emergencies aren't going to stop. And they're probably going to be even more traumatic than they are now. The car's going to break down, or the boiler's going to break down, or the roof's going to leak, or this or that. If you haven't previously set up an emergency fund, you might take a small single payment along with your monthly payments and the annuity. Transfer it to an IRA so you don't have to pay the taxes on it. But that could be a source of liquidity or emergency money. Or maybe you just want to pay off debt before you fully retire. You might take a small single payment to pay off your mortgage or pay down a car note. So I'm sorry, I don't know percentages of who does what, but I don't think it matters. I think what matters is your own personal situation and what you need to do to cover yourself. That wasn't really an answer to the question, but. And you said that was the last one? Okay.
We'll get to the people. But send me more people to answer, but we'll get them online.
Okay. So we aren't going to do it while they're online. We're just going to wait and respond later? Or? Okay. Well, in that case, I guess we're done. Thank you all very much, and go out, save a lot of money in the TSP, and retire happy.